conducting webinars, and you chose ours. So thank you very much. This is Craig Harm, National Accounts Director at TRA. I just wanted to go over some housekeeping items before we actually begin the 1-hour CE webinar course on cash balance. One of the hottest topics of the year, no doubt, and it will be the rest of the year. Just from a housekeeping standpoint, you'll be on mute for the call, but you can still ask questions on the right-hand side. And what we'll do is answer those at the end. We know some of you have to jump off at the end after the 1-hour CE. We get that, but for those that want to stay on the call after the hour, we're going to go through as many questions as we can, and a chance to help our partners like you from that standpoint. So, and during the call, the webinar today, there'll be some polling questions that you'll see out there, and just kind of interactive, kind of fun, kind of keeping us all on our on our feet and on our toes. So to get the CE, you have to be logged in for the entire hour on the system. It captures that. And the CE certificates are going to come out from the Retirement Learning Center. You'll see that logo on the right-hand side. Many of you know our great partner there, John Carl, and all the great work the Retirement Learning Center does. They're going to be sending out the CE, and I'm going to talk about the email address that's going to come from, because I want to make sure you check your spam folder. It very well could go in there. With that, let me kind of turn it over. Let me go into the cash balance part of this webinar that Tom's going to be doing. But today you get a 3-for-1. How often do you do a webinar where you get 3 industry experts on one call? And we've got that today. We've got Tom Powell, who I'm going to introduce as the keynote and our lead speaker. Also, you may hear John Markley pop in. He's our head of industry relations, 45 years in the business, a veteran of the actuarial world, to say the least, speaks at many, many conferences, many, many webinars. You all know John, and I've heard him. Also, John Carl. I mentioned him in our partnership with the Retirement Learning Center, president and founder of RLC. You've seen him on CNBC. You've seen him on Fox. Many industry publications out there, and really, RLC is the premier consulting firm out there. It's a think tank for our business. So I encourage you at the end, I'll show you their email address to reach out to RLC as well. I'm going to introduce Tom in 1 second. I want to go over the TRA story real quickly as we begin. And with that said, I can't thank you enough for a fantastic year we had last year. Together, we don't do retirement plans and TPA work without you, the advisor, and the retirement specialist. So thank you. Our 25th year, a national TPA, as you know. What's important to you, as I look at 10,000 plans that we're administering and some $10 billion in assets, that's scale and size. What do we use scale and size for? Wow, to increase our staff with regional sales consultants across the country, to increase our client relationship managers that help service the plans that many of you work with. That's 50 now across the country. Our own cybersecurity team, our own IT team, our own actuarial team. And last but not least, and price isn't everything, but price is important, right? Price backed by service is critical. And in our case, we help, roll down the cost savings we have with scale to our pricing model across the board. If it's 316, which we had a record year last year, cash balance was our best year ever last year. If that's how we do plan design and pricing for safe harbor plans, we roll these prices and the chance to reduce expenses right back to you guys. So I encourage a couple things after the call, and you'll hear from us. Ask one of our regional sales consultants if you haven't done a plan with us. Ask for a pricing sheet and let us do a quote. So with that, I want to turn it over to Tom Powell. Again, Tom's 35 years in the business. Tom came to us last year, which is interesting, from Plantech. Many of you know Plantech as a very strong TPA in the southeastern part of the country. Tom's leading our actuarial team as well, and our business development team in all things 316 cash balance. And the unique perspective Tom brings to the table, not only as a past owner of a TPA, and again, we purchased PlanTech last year, which was our 29th acquisition, by the way. Tom comes with a viewpoint of presenting as an advisor as well. Since he is one or has been one, Tom's angle on his presentation are real life situations on what he's experienced in plan design, what he's experienced in working with plan sponsors right across the table, not only from a TPA, not only from an actuarial person, but also an advisor. So with that, I'm going to turn it over to Tom. At the end, I'll come back on one more time for what I'll call round 2 of housekeeping, how you get the certificate, what we'll be sending you, and also before you close out, we'll have a small survey for you to answer. We always want to get better. So once again, Craig Harm, National Accounts Director at TRA, can't thank you enough for blocking out time today. We know your time is valuable. So here's the 1-hour CE course coming up with Tom Powell, John Markley, and basically the rest of our team, including John Carl. So thank you again, and look forward to recapping all this at the end. Tom?
Thanks, Craig. Thank you very much. It has been a privilege of mine for all these years to have friends who are advisors, and they invite me to their meetings with their clients. And we have developed a very systematic method of gathering the proper information and working with them, and it'd be a privilege to work with any of you. Pre-COVID, we actually had in-person meetings, which is a lot more fun, but we'll do the best we can if we have to do it via a televideo type conference call. But we thank you very much for being with us today, and here is our agenda. We have several learning objectives. We're going to cover cash balance at a glance. That's a one-page overview of how cash balance plans operate. We're going to look deeply into the tax benefits of cash balance plans. We're going to try our best to help you identify the prime prospect for a cash balance plan, do some case studies, and at the end, we'll do some questions. So you'll be able to ask questions that might be on your mind. And we have John Carl, Professor Markley, and I will do our best to answer them for you. Now let's look at our learning objectives. It's very, very important to understand what our role is. Our role is to help you win. Our role is to help you help your client. Understanding how to help business owners lower that tax burden through a cash balance plan is going to be a primary objective today. Familiarity with the basics of cash balance plan design, and we don't have to get deep into the weeds, but we can if necessary. But it's a very, very popular plan design. We'll go into many attributes of the plan design. Why do we pair cash balance plans with 401k 401k profit sharing plans? Obviously, they optimize each other, and we'll go into that as well. How can we use a cash balance plan for succession planning? You'll find out that, especially in family-owned businesses and mom and dad are getting up in years, there can be a very tax-effective way to transfer to the next generation. It works really, really well. We want to make everybody aware of the roles of the advisor, the plan sponsor, and the actuary and third-party administrator. Obviously, at TRA, we want to be that third-party administrator, and we want an opportunity to earn your business. And then one very, very critical opportunity here. How do we identify suitable candidates for a cash balance plan? Obviously, you have lots of clients and you have a lot of demands on your time. So if we can help you identify those candidates more effectively, more efficiently, then we certainly want to do that. And as we used to say years ago, the geek in your pocket. So when you need us, we want to be there and help you win. Let's talk about the opportunity. We're in a very interesting time. Historically, plan sponsors had to adopt their plan by the end of their tax year. The Secure Act came into effect in 2019, and that lets employers adopt a cash balance plan or profit sharing plan for that matter in 2021 for 2020. we've always said visibility is critical in cash balance plans because you're committing to a contribution. Well, this is a fantastic opportunity. For 2020, the year's over. If it's a calendar year tax year, it's over. The CPA knows what the profit margin is. The employer, the business owner, they know what their tax bill is, or they will pretty soon. They have 2 years worth of visibility. They can see the year that's already happened, and they're already into March for the year that hasn't happened. This is great. So now, I used to say, when we're meeting with advisors and their clients, and the advisor would say, well, what do I have to expect? I mean, how much lead time do they have? And the answer is, historically, I always say, be comfortable with the year you're standing in and be comfortable with the year in front of you. Well, right now, you got both. You can see the year that's already happened, and you can see the year you're standing in, and you can project the year one more out. So that's 3 years. This is a very unique opportunity. The Secure Act is a fantastic opportunity to consider cash balance plans and also profit sharing plans if a plan sponsor doesn't yet have one. Also, the tax credits may apply. If a plan sponsor is eligible and hasn't adopted a plan yet, about 50% of the implementation costs, which is what TRA charges, obviously, to implement these plans, that administrative side, that's us. About 50% of those costs, up to 50%, can be covered if the plan sponsor is eligible. So that's another great opportunity as well. Now let's talk about what a cash. Oh, we have our first poll question. It's ERISA Jeopardy. Let's give them a few seconds to respond and see how we turn out, Bill. Which plans is or are not required to pay PBGC premiums? Owner-only cash balance plans, defined benefit plans maintained by a small organization, a safe harbor 401k plan, or all the above? There's our results. That's our poll question results. How did we do? Number 4. That is our correct answer. Thank you, everyone, for participating. We really appreciate that. And we just mentioned our tax credits, and now we're going to talk about what is a cash balance plan. Cash balance plans are covered under the same code section as defined benefit plans. They're actually 100% funded by the plan sponsor, i.e. your client. The company guarantees eligible employees a specific benefit. We typically call that a pay credit. And instead of having the investment results like a 401k or profit sharing plan that's participant directed, and the investment risk is taken by the employee, the investment risk is borne by the employer. And a specified interest rate is in the plan document that says that's what the employee, i.e. participant, is going to be credited with each year. This is an important point. Defined benefit plans, as you may already know, state we're going to give you X% of your pay per month for the rest of your life starting at retirement age. That's a bit of a difficult concept for most participants to understand, but in a cash balance plan, you have a beginning balance, you have a pay credit, you have an interest credit, and an ending balance every year. And that's what the TPA and actuary do each year, is produce those benefit accruals and track all of the benefit accruals and the investment earnings and generate statements and do the actuarial valuation. We use cross-testing methods to allow companies to push benefits to the employees that they need to. So this is a very important feature. You could have 3 owners or 5 owners or different groups of employees, and each one of those can get a different benefit accrual or pay credit in the plan, as long as the plan passes testing. So let's move on to the growth of cash balance plans. Historically, small defined benefit plans, like in 1985, there were like 90,000 of them. Cash balance plans in 2001, we only had 1,337. By 2017, more than 20,000, and that trend continues to move forward. Currently, we've got cash balance plans that are well over $1 trillion in assets in this country. Got more than $12 million in participation more than 12 million participants. And Professor Markley, I think you might have some information here that is very important if you would share with us.
Thank you, Tom. Yes, during the last year, TRA actually added more cash balance plans than we did in 2019. So think about that for a minute. Even with the pandemic, cash balance plans have continued to increase and provide a significant opportunity for employers to make tax-deductible contributions. And as we look at January of 2021, we've had a 7-fold increase in the number of new cash balance plans. Now, of course, that's related to the ability to implement a plan for 2020 until your tax due date, but still, the growth of cash balance plans continues. So, Tom, back to you.
Thank you, Professor. I appreciate that very much. Now let's do cash balance plans at a glance. This is a very, very important slide, and here's why. If you can understand this slide, this is what you're going to be explaining to your client. And most of us know most of this, but we're going to add that fourth bucket of money to the plan, to the employer's ability to save for retirement. The first bucket, we're all familiar with it. Every participant in a 401k plan that meets eligibility can choose to make Roth contributions or pre-tax contributions into the plan. We all understand that there's a statutory limit of $19,500, and if you're well past 50 like me, then you can do another $6,500 catch up, and a few other people on this call that will go unnamed. Experience counts, though, by the way. So the next bucket is we typically see in a cash balance combination situation where we have 401k profit sharing and cash balance plan. You're going to have a company match or a safe harbor contribution, and that allows us to, obviously, the highly compensated group to maximize their deferrals. Most of the time, but not all, the 3% non-elective safe harbor works best for that bucket. The next bucket is discretionary profit sharing, and this is important. In professional practices and other ideal candidates, many times we have a 401k safe harbor plan and we add profit sharing and try to maximize the profit sharing for the owners and be as efficient as possible with that and keep the cost under control for staff contributions. And sometimes those contributions will be 5 to 7% depending on the age and demographic of the people in the plan. Oddly enough, in many instances, we can add now the fourth bucket, a cash balance plan, and many times not have a huge impact on the amount of contributions that have to go to the non-owner staff. It varies widely depending on the circumstance, the census, the age of the employees and participant, the age of the owners, etc. But these are very important. These are two separate plans. The first three buckets are in your 401k profit sharing plan. The fourth bucket is your cash balance plan. They both have their own plan documents. They have their own 5500. These both plans are ERISA plans. They're qualified retirement plan vehicles, so they're protected from bankruptcy and or litigation risk, which is very, very important, obviously, for most business owners. It can be very important for your medical professional clientele. So we'll refer back, we'll mention this slide again later when we're doing an actual example, and we'll look at each one of these four buckets. It's a great high-level slide. I wish I could take credit for it, but I suspect Professor Markley must have done that. So let's move on to the next slide, please. So how do cash balance plans work? In general, if an employer already has a 401k profit sharing plan, most of the time, the eligibility criteria will match that plan. However, sometimes eligibility can be changed to a maximum time period. Vesting on a cash balance plan can go out to a 3-year cliff vesting. Earned income is considered for benefit calculations. and that sounds pretty familiar, I'll imagine. Cash balance plans are typically viewed as what percent of my pay am I going to get as a pay credit in a cash balance plan. Many times in profit sharing plans, you've heard, what percent of pay do I get in my profit sharing plan? I'm sure your clients have asked that many times. The TPA and actuary analyze the employee census to build a proper plan design. And we hope we have the opportunity to be that TPA and actuary at TRA. The plan design also, it's important to remember, can be impacted by the type of entity that's involved. If it's a sole proprietor with no employees, or a sole proprietor with employees, or an LLC taxed as a partnership, or LLC taxed as a corporation with an S election, etc. We will ask all those questions as we do the plan design and assist you in winning the business. So the employer makes annual contributions typically after the fiscal year, especially now. So if we're looking at putting in a plan for 2020, obviously that year's over, and so the employer would make that contribution after the fiscal year. However, once the plan's up and operating, many times employers will choose to make quarterly contributions during the plan year, and that helps them with their budgeting and cash flow management, which is a really good idea. The assets are invested in a single pooled account. As an advisor, we'll talk more about this in the future in just a little while, but that's actually a very convenient type of arrangement for your client. You have one account. You don't have, if you got 30 people in the plan, or 28 people, or 10 people, you don't have that many accounts to deal with all the time. You have one pooled account with a consistent investment objective that we'll discuss in a little bit when it comes to the cash balance plan. The TPA keeps record of all the benefit accruals and performs annual compliance testing, generates participant statements, also does the actuarial valuation, and we certainly hope that TRA can be that TPA for you. So why do we combine the defined contribution plans, i.e. 401k profit sharing plans, with the cash balance plan? Well, obviously in both plans, since these are qualified plans, employer contributions are tax deductible. That is really, really important, obviously. A well-designed plan, the goal is to have a net tax savings, a net savings period for the business. So, for example, you'll see an example later that 90% of the contribution to the cash balance plan goes to the owners. Well, if they're in a 40% tax bracket, or even a 30 bracket, and they're getting 90% of the benefit, they get to choose. I can give a little bit of money to my staff who work for me and keep the bulk of it, or I can give a lot of money to the IRS and my local and my state tax authority who don't work for me. So most people would rather give it to their employees, and that's the goal. We really want to do a good job in our plan design efforts that we do for you and your client, and we do that at no cost. We do that to try to get an opportunity to win your trust and win the business for you with your client. That's our goal. We can also produce competitive employee benefits and golden handcuffs for highly compensated employees. Believe it or not, that is probably more important now than most of us realized. Many business owners I've spoken with recently are having a very difficult time finding highly competent key employees, and this can certainly be a competitive advantage when you're competing for great talent. ERISA plans are sheltered from creditors and bankruptcy. That's important. My personal experience over the years, we've been fortunate and haven't had clients that had to rely on it very often, but in two cases over the many years we have. One was a medical practice and one was in a different industry, but nonetheless, the risk did not actually come from their industry. The risk came from an automobile accident in one case and a piece of rental property in another case where someone on the rental property was injured, and a lawsuit was filed in both of those cases. And their assets in their ERISA plans were protected. Very, very important. Another possibility for cash balance plans combined with 401k profit sharing plans is you can accumulate a lot of money on a tax deferred basis in a cash balance plan and 401k profit sharing plan. And that can be blended into your exit strategy or a strategy of selling the business or passing it from one generation to the next generation, and it becomes a more marketable situation. Tax deductible contributions versus after tax purchases of the business is a very powerful concept. So now designing a winning combo. What is our typical situation? Step one, in most situations, we want to take full advantage of the 401k component of the plan. Either if you're under age 50, you want to get 19.5 into the plan. If you're over age 50, you want to get that extra $6,500 into the plan. And then a properly designed profit sharing plan, which also is available for 2020 and 2021. The deferrals are not, but the profit sharing is. You can set up a profit sharing plan for 2020 even today. Properly designed after thorough analysis of the census data, that can give people 60 grand or so, as you all know, under the 415 limit. So that's our first step. Let's take advantage of what's available. Next step, layer the cash balance plan on top of the 401k profit sharing plan. This is very, very important because these two plans are tested together for compliance purposes. For example, if we're trying to give an owner $100,000, because of the method of testing these plans together, benefit under both plans is combined for that test, and we get leverage out of testing the specialized testing methods when we do these together. Each plan depends on the other for optimization. So the profit sharing component is the lever we can move around to make testing be effective and produce the desired result. Now let's take a look at why we want to do. Oh, here we go. More of us at Jeopardy. Everybody ready? Which statement regarding cash balance plans is not true? Is not true. Let's see. No employee contributions are permitted. Younger participants receive larger contributions. Owners' contributions vary based on their income. Annual contributions are required. Let's give everybody a little time to respond. And there are results. Look at that. 77% were 100% accurate. That is not a true statement. Younger participants receive larger contributions, not so. Thank you, everyone. We really appreciate your participation. Back to our winning combo. Actually, next slide. There we go. Thank you. All right, so we've discussed why do you use a combination of a cash balance plan and 401k profit sharing plan. Over the last 30 plus years, we've designed many, many, many plans for people in their 60s, 50s, etc. And there's going to be some examples as we move along, but I'm going to give you a couple anecdotal cases. For example, there was an eye surgeon, and he was in his 50s, and he had children. They're grown basically at that point. College is paid for. He wakes up one day and goes, "Wow, if I'm going to live the same lifestyle in the future, I really need to save a lot of money." So he turned 60 in that first year. So we designed the plan for him, met with his advisor, and he and his accountant as well, which is very, very important, and designed a plan so he could put away approximately $250,000 a year. That was his goal in mind. And so he did that. And he did that for, I want to say, 13, 14 years. And with the interest credits and and the accruals over time, he wound up with $3 million or so in his cash balance plan. And so suddenly he was ready to slow down anyway. He didn't operate anymore, and had some younger guys come into the practice, and they were not included in the plan, but he could keep accruing benefit in the plan for a while longer, and that really made it easy for him to transition out of his practice. But it also met his tax savings needs, and it also shielded those assets from litigation, from other issues, not just medical risk, but also from other litigious activity that could come about, because he did own some rental property. Second of all, and I'll mention this here and I'll probably mention it later, many states, and I'll use our state, and I live in the South, I live in Alabama, our state doesn't tax pension benefits. So interestingly enough, and this is something you'll have to verify with in the state where you're practicing, interestingly enough, that particular doctor, and anybody else can as well, can roll that $3 million out into an IRA, and that $3 million becomes a basis for state income tax purposes. So that $3 million will not be subject to 5% state income tax. That's $150,000. I joked with him. I said, well, that's fantastic. You can go buy a new sports car. You need a new Porsche. And I got an eye roll out of that. And he said, well, you'll have to talk to my wife about that. So apparently he was not going to buy the Porsche, but I thought it was a good use of the money myself. But that's a great example of how that works. If you look at the bottom of that chart, the person at 3034, there's a neurosurgeon. The advisor called and said, hey, she can't really save much money. I mean, it's just not going to be enough. And she was in practice, and she's the only employee. I mean, she don't even have any employees. I'm like, well, there's another alternative. So she does her 19.5. We get all the way to 58 with using profit sharing, and then another $50,000 or so. And I think hers turned out to be like 111 because she's a little bit older, but $111,000 a year. That matters. He's a hero. She dearly loves her advisor, which is great. That was our whole goal in the first place. So those are some anecdotal examples of how cash balance plans combined with 401k profit sharing plans can work very well. Now let's look at an actual example. Next slide, please. This happens to be a professional organization, professional dental organization. And we're going to walk from left to right across these columns because this is exactly what Cash Balance Basics, our slide on the front end of our presentation, was all about. So you'll see under considered earnings, we have three owners, one at 285, one at 215, one at 155, and they're also different ages. We'll go to one more column to the right and look at their accrued benefit. This is the amount that we're going to accrue in the cash balance for them as a pay credit each year. Obviously, age matters. The next column is the percent of their pay that's being accrued in the cash balance plan. The next column is their 401k deferrals. Those lucky folks that are old like me can do their 26, and the younger one cannot, not yet. The next column is safe harbor. That's a safe harbor 3% contribution. The next column is profit sharing. You'll notice that we have profit sharing for owners and staff. But here's an important point. If we were just maximizing the profit sharing for the owners, those numbers would be a lot bigger, but that we would not get past, $58,000, $63,000. So, but we're still having to give the staff 4% in profit sharing here to pass. That probably wouldn't be that different if we were just maximizing the profit sharing. But we're getting the owners that column. That's how much money they're getting into their retirement plan every year. And it's only costing them about the same as it would otherwise with the profit sharing plan. So that employer cost column right there, let's go to the bottom chart, if you don't mind. That employer cost column, the employer is spending $638,000. $32,000 of it's going to staff. I'm sorry, I said that wrong. They're spending $671. 32 of that's going to the staff, 638 is going to the owners. That is fantastic. especially if you're in a 30% bracket or probably 40 bracket. That is fantastic. They're getting 95% of the total money that goes into the plan. So it's a huge win, absolutely huge win. In the cash balance plan, if you go to the left side of that chart, you'll see that the benefit accrual is $606,000 for the principals and $7,000 for the non-principals. So by adding this cash balance plan and adding that $613,000 potential contribution, 92.5% of it went to the owners. Professor Markley, I'd like for you to jump in here if you don't mind and give us your thoughts as well.
Yes, thank you, Tom. Well, as Tom mentioned, the Secure Act is effective for the first time for 2020 plan years, which allows employers until their tax due date to set up a plan. So just to emphasize that, I'm thinking that every financial advisor on this call has a client who can benefit from establishing a plan now. Their accountant has a good idea of their tax liability. So if a potential client or a client calls you up and says, I've got a big tax liability, I don't know what to do about it, this could be an opportunity to have them save taxes. And then as Tom mentioned, let me keep going here. So this would be an example of an employer that you could approach now, and maybe they could have a significant tax savings for 2020. But with a bigger practice like this, they probably need a year of planning in terms of paying out the owners in order to implement the cash balance plan. So in fact, this group was a client of our firm. We helped implement the plan before we were acquired by TRA, and we approached them in October, and they were disappointed because they had just paid out third quarter bonuses to the owners, and the funds were not available within the business to make the tax deductible contribution. But they could still set up the plan for the following year and make plans accordingly. And then the three owners would be completely aware of what the implications were of making significant contributions for their retirement. So a larger practice like this, and even larger than this one, cash balance plans are very popular. I think the latest thing I saw was that 150 of the law firm 200, that's the largest 200 law firms in the country, have cash balance plans. So do a lot of medical and dental practices. So within successful businesses, cash balance plans are very prevalent. And if you run into one that doesn't have one, we can help work with you to help to develop a design that looks like this and help to meet the goals and objectives of the employer. And then as Tom mentioned, so actually this plan that we're looking at here has now been in place for several years, and the owners have between $1.5 and $2 million of benefit in their cash balance plan. So imagine what a winner you would be with your client if you help them implement a plan where each of three owners have between $1.5 million and $2 million in the plan, and it can continue to grow up to close to $3 million for each person. So with that, Tom, back to you.
Thank you, John. Let's back up to the previous slide for a second, if you don't mind. Thank you. Here's one other point I wanted to mention here, and the 2017 tax law changes brought about something called the qualified business income deduction. And that's a weird animal, but we're going to encourage you again to market to your CPAs and their clients. If without a cash balance plan, some employers, and we've actually done this, their income was high enough to where they could not take advantage of the QBI deduction. Basically, you take 20% of your pass-through income in an S corporation, LLC, taxes, partnership, etc., any of the pass-throughs, and you take a deduction from that, so it reduces your effective tax rate dramatically. In one particular situation, a financial advisor that we worked with regularly, we put a cash balance plan in for him, and he called it. He said, "Hey, you remember client XYZ, and you talked to them about the QBI?" And I'm like, "Yeah." He said, "I'm in that situation right now," and we were able to get his contribution situated so that he could reduce his income to a point where the QBI applied, and that reduced his tax rate from literally 40% to about 23. Is an amazing difference for him. That's a little bit in the weeds, and I apologize for that, but if it comes up and you're speaking with the CPA, they will understand what needs to happen to get their client eligible for that QBI. Sorry for backtracking, but I thought that might be another useful tip that could help you win some business, and that's the whole goal here. We want to help you win. So let's move forward to the next proposal. Professor Markley, I think you actually did this particular plan design, if I'm not mistaken. So I'll let you take it from here.
Yes, thank you, Tom. So the situation here was that a financial advisor was working with this client and thinking that the $58,000 that we've talked about would be the maximum tax-deductible contribution that they could have, because they're only 40 years old, and with a cash balance plan, would that really allow additional tax-deductible contribution? And so we were able to show this design where the considered earnings were $285,000. So we could design the cash balance plan to be in and of itself nearly $100,000. We show the 401k deferral. Profit sharing in this case would be limited to 6% of considered earnings for 17-1. So to make a long story short, instead of the $58,000 limit on tax-deductible contributions for this individual, they in fact were going to be able to contribute $135,000. So this business owner was very happy with that ability to save an additional $80,000 a year, roughly, on a tax-deductible basis for their retirement. So I think one point of the items listed below that I think Tom and I both like to emphasize is that we want to make sure the CPA for the client is involved. We don't want them to be surprised when the employer makes a big contribution to a retirement plan. And in fact, they can end up being your biggest advocate in having that client set up a qualified retirement plan for their purpose. So, Tom, back to you.
Actually, Professor, you're going to do the next one as well, because you came up with this one as well. I love it, but I'll let you take the credit.
Okay. Thanks again, Tom. Yes, so there's a lot of points I want to make with this plan proposal. For example, some are pretty subtle, like notice the 401k deferral says not applicable. That's the one area where we can't set up a 2020 401k deferral now that we're in 2021. Those have to be payroll deducted based on income during 2020. But you can see there's a lot we can do here. And this employer, in fact, could do 401k deferrals in in 2021 if based on setting up this plan. The other subtle point I want to make here is, so we got this information about a 56-year-old business owner with earnings of $50,000, and what can they do for retirement? Well, there are IRS rules that allow us to look backwards with their prior history of being self-employed, and maybe they had earnings greater than the $50,000 in prior years. And in fact, it turns out this is a real estate agent who's been very successful over the last 25 years. So they've been in business well over 10 years, and they had many consecutive years of compensation over $250,000. So we're allowed to design the plan as if they have $250,000 of compensation and they've been in business for over 10 years. So, and what happened this year to make the considered earnings $50,000 was that they converted to an S corporation, and so basically above the $50,000 is going to be S corporation profits. So they still have additional income beyond the $50,000. So if this had been a business that was only in place for 1 year with the compensation of $50,000, actually the maximum cash balance contribution would have been about $45,000. But because we can recognize past years, we're able to have a cash balance contribution of $220,000. So if you want us to do a plan design for you and we ask you a lot of questions, it's because we want to do a better job in designing the plan to meet your client's goals and objectives. So this business owner could also have $3,000 of profit sharing contribution, so they could contribute $223,000 for their retirement. I think the rest of this is somewhat self-explanatory. So I think I will jump back to Tom. Tom?
Thanks, John. Thank you very much. One of the most prevalent questions that we often get in all the meetings we've had over the years with the advisors and their clients is, what happens if something changes? Well, let me take a step back for a few minutes and talk about how the cash balance plan works one more time. So let's assume in this example that we have an owner-only plan and the pay credit for the owner is $100,000. Well, several things impact that after the first year. The first year, the pay credit's $100,000. Our maximum deductible contributions, $100,000. They actually made a contribution, $100,000. In the future, three things impact what happens regarding our contributions. First thing is, what contribution did you make last year? Well, obviously the first year you put in the pay credit. That's great. In the second year, we have to make that decision. When the actuarial team at TRA does the actuarial valuation, here's the things that matter. How much pay credit do we have? How much interest credit do we have? Those matter. And now, investment performance. So, investment performance could be more than our 5%, or it could be less than our 5%. We typically use 5%, which we'll talk about later, as an interest credit because it helps us maximize the benefit accruals. So the questions they ask is, what do I do 2 years in or 3 years in if cash flows down? Well, there are options that are available. You could freeze the plan, potentially amend the plan, potentially terminate the plan. But in strategic planning, we'd like to see plan sponsors, if they can, to pre-fund the plan, which is what we're going to talk about right now. So in 2020, the pay credit for this particular individual was $100,000. So his maximal contribution was $100,000, and he made the $100,000 contribution, took a tax deduction. In 2021, we do the actuarial valuation again, and generally speaking, you can put in 150% of the accrued liability in the plan. So there's our $100,000 for our minimum contribution, $150 is our maximum deductible, and then he has a decision to make. Do I make somewhere in the middle, 125, whatever? He chose to make 150 maximum deductible contribution. If cash flow is good, it's a great idea. Down in my part of the country, we say this. I've heard it all my life. Make hay while the sun is shining because you might need it. And so in 2022, he still gets another $100,000 benefit credit. But since he's funded in advance for those prior years, his required contribution is only half of the benefit accrual. Maximum contribution is $150,000. He actually made that $150,000 contribution. By 2023, his minimum required contribution is zero. Fortunately, under John Markety's leadership and the rest of the actuarial team, there's many, many plans, cash balance and defined benefit at TRA, that don't have a minimum required contribution. And that's a wonderful place to be. So there is some flexibility here, and pre-funding is a great idea in case you do have a bad year in the future. And so this particular year, the business owner decided not to make a contribution, and that's perfectly okay under these circumstances. So that's an important lesson, and it may offer you some bit of comfort as you talk about putting plans in for plan sponsors. And we'll talk more about this as we move forward in our presentation. Now, let's talk about how funds are invested. We often encourage, we always do, we encourage advisors to target the rate of return that correlates with the interest crediting rate. You've heard me mention 5% before. 5% currently is viewed as reasonable. And think about this. Based on that last example that we just did, if you were investing this money and you had a banner year, 25, 30% year, which would be a fairly aggressive portfolio, so I'm told, that may reduce the amount of contributions that you can make into the plan. On the reverse of that, what if you made or lost 2%, let's say, or lost 5%, or whatever the case may be? If that happened, obviously that difference is going to have to be made up. But if you have one year where you lose 5%, another year where you make 10, you're approaching a wash. The good news is we can amortize that shortfall, if there is one, if you have a down year, over about 7 years. But volatility in the assets of a cash balance plan create a little bit of uncertainty for the plan sponsor, and many advisors and plan sponsors worry about that, and it's understandable. So that's why we encourage that the portfolios you build and construct for these cash balance plans target that 5% interest crediting rate that's specified in the plan document. Oftentimes we hear people discussing, should we change interest crediting rates? We encourage you not to. The reason being, you wind up having to do record keeping up to the point of the 5% interest crediting rate, and then begin again and keep separate record keeping for a different interest crediting rate. Basically, it just increases complexity, and it's just a little bit inconvenient for your plan sponsor to have to see all that and explain it to participants and so forth. So we encourage avoiding that. So investment results do impact funding. That's exactly right. It does. And we've actually seen it go both ways. I promise this really happened. We had another physician, and his instructions and discussion with his advisor was, I don't want any risk. I don't want any risk. I don't want any risk. So the advisor found a way to get that done, but the earnings were always 2 or 3%. And the physician said, I don't care. If I have to make a bigger contribution, I don't care. So the advisor did as he asked, and it worked. That's fine. Then you have it go the other direction, where somebody says, I just can't stand this conservative portfolio targeting 5%. Those typically are not as happy because they wind up with a lot of volatility, and their contributions can move around over time. So it's better to target the interest crediting rate. It really is. Now it's our poll question. More ERISA Jeopardy. Which statement best describes the cash balanced investment strategy? An ongoing specific rate of return is targeted. younger participants receive a higher rate of return. Each participant determines appropriate investment strategy. Fixed annuities are the only permitted investment option. Let's give people time to respond. Approximately 90% of our audience is 100% correct. An ongoing specific rate of return, number one. Thank you very much, everyone, for participating. Here is, this is where it becomes very, very important to recognize your candidates, ideal candidates for a cash balance plan. You saw two owner-only examples that John Markley did illustrations for and actually implemented those plans. Owner-only employers. Owner-only employers can be an owner and a spouse as well. If they don't have any employees, then you don't have to jump through as many hoops with regard to testing and so forth. Those are perfect candidates. Probably the easiest thing in the world to do is to give them a cash balance plan and really, really dramatically impact their tax liability, and they'll be so thankful. They'll never leave you forever. I mean, that is the outcome every time. Medical groups as well. Medical groups can be small or large, and you never know. But generally speaking, the most popular plan design that I've seen in my 30 plus years is medical groups do a 401k, safe harbor, 3% non-elective with profit sharing and a cash balance on top. And then the owners, depending on age, can select the benefit accrual that works best for them. And then, and some of your younger physicians, I have two of them in my family, they chose not to participate in the cash balance plan on the front end because each one of them is a revenue center. But then the older guys, people my age and up especially, they want to get every dime they can because they went through medical school, they paid off their school loans, they raised their family, and now they got to play catch up. That's the long and short of it. So medical groups are a very, very, very important group. CPAs, similar. They're professionals. They got all the same demographics, basically. Law firms, as John Markley said previously, most of the largest law firms in the nation have cash balance plans. Financial services. I've done these for practices of financial advisors that we work for and with, and it works very well for them. Consultants, hedge funds, IT industry, basically consistently high cash flow professionals and businesses. And we like to emphasize consistently profitable and consistent cash flow because that makes it simpler for them to implement a cash balance plan. And I mentioned previously that several states don't tax defined benefit pensions. Well, that would include cash balance plans as well when the money comes out of that plan. So that's important as well as you're speaking with your professionals. Not so ideal candidates on the next slide. So probably most of you on the call have put in plans before. And as you put in plans, you discovered that the plan sponsor does have a little bit of work to do, or an office manager or someone in their office has a little work to do. If they've never had a qualified plan before, it might take some education to get them ready to have a profit sharing plan and a cash balance plan. So that's one point of consideration. If you have major fluctuations in profits for the company, or if the owner's compensation is very volatile, they can certainly be great candidates for 401k profit sharing plans, but maybe you might pause on a cash balance plan to make sure they fully understand the implications. Also, if you have a lot of turnover in the employees, that may be a red flag for a cash balance plan. It depends, so it's worth it taking a look. But if it's a constant turnover, it might not be the best candidate. But all of those would still be good candidates for 401k and profit sharing. So keep that in mind as well. On our next slide, we're going to discuss business owners' top priorities, and we're going to bring in our partner at RLC, John and Carl. They get about 1,100 calls a month from advisors seeking information about building plans, what's the appropriate plan for this particular client, etc. So, John, Carl, if you'll join us, that would be great.
You betcha, Tom. This is my slide here, as we get a lot of those calls from advisors with clients like this. And I just categorize them into three categories. One category is the advisor that's working with a business that's had some trouble with the pandemic, and we're supporting that advisor redesigning the plan. Not a good candidate for cash balance. But the other two kind of calls that we're getting are ideal. Number one is that I'm going through right now with my CPA. Some of you might be on the line, and I'm figuring out I had a better year in 2020 than I might have felt in a pandemic. And as you pointed out, Tom, the good news is that we can look all the way until that, the ultimate with extensions up into the third quarter on writing in a profit sharing or possibly cash balance. We've seen more serendipitous cash balance plans drawn up at the RLC and sent over to you good folks at TRA to implement than we've seen in quite some time. And then the other type of call, Tom, that we get is the prospective call, where I don't know what great state you're in right now, but it's 50-some degrees in New York, and people are getting vaccinated, including my wife this week, and people are looking at the prospects for good things to come, and then they're stepping back and they're saying, well, what are we going to expect out of Washington? And I can tell you the one thing they're not expecting out of Washington as a business owner or a partner in a firm is lower taxes. So the prospective calls that we're getting is, if things are going to improve like we're expecting them to do, what can we do to keep more of what we earn as a business owner? And it goes back to having an ideal plan design, Tom, and that's all the stuff you talked about. The other thing I wanted to really stress, and you mentioned this earlier, and I can't stress it enough for the advisors on the call, there is no case that is too small to consider this enhanced plan strategy. Which starts with, of course, new comparability rules, profit sharing. But if you have that organization that is showing signs of life through 2020, good times to come, hopefully going forward, there is no plan too small. John gave you two different examples: the surgeon who was putting away $250,000 a year, and then another doctor that was putting away a much smaller amount. It doesn't matter. You as the advisor, when you bring to the table, it's not just what you help the business owner earn, it's what you help them keep, or the partner in the firm. Boy, that really differentiates you. So there's no case too small, and I would just urge you to be sharing this news with your business owner clients and assessing with their CPA what's going on, what are you expecting going forward, and we're here to support you, certainly at the RLC, good partner of TRA, in getting that ideal plan design. So that's it, Tom.
Well, thank you very much, John. I would encourage everybody to reach out to RLC and take advantage of the expertise that they have, and they'll share readily with you. All right, so what is the process of starting a cash balance plan? Obviously, we said previously we would ask a lot of questions, and we do that not to annoy you, but to give you the best possible plan design that we can. And that helps you win and helps your clients solve their problem, pay less taxes, keep their key employees, and reach their financial goals. So we analyze the demographics, the census, the type of company, etc., and we could create the optimal plan design. Then at TRA, we then draft plan documents, and plan documents reflect the result of that analysis. So the provisions that you see in the numbers, like in that example we showed you with the 3 dentists, those are what produce that plan document. We have to reflect that in the plan document. Next, an account is opened by you, the advisor. You meet with your plan sponsor, you choose your investments, and manage the portfolio to target the interest crediting rate. The TPA handles all the compliance matters, and you guys as advisors handle all the investments. Obviously at TRA, we want to be the TPA, and we hope you will remember us in that capacity. Now, the process. Define your client's goals. This is a very, very, very important slide right here. I'm going to give you a football analogy. When Bill Parcells was the coach at New England, he got sideways with the owner, and the owner wouldn't let him have any input into the players. and he made a comment, and this may not be an exact quote, but it's similar. He said, if you're going to make me cook the meal, I need to have some input into the groceries that we buy to put into the meal. So we're not being arrogant, and we're not being really trying to bother you, but if you would give us as much data as you can, and we're trying to be preparing a gourmet meal. So when we ask you a lot of questions, please accept that we're being humble. We just need information to do a really good job. So we get that information from you and your client, about the company's goals. For example, and this happens often, you may have medical practice as a prime example, or young lawyers versus older lawyers, and each one of them may have a different desired target amount to save for retirement. So we always ask it this way: Mr. Client, if you have an ideal number that you could save on a pre-tax basis for yourself, what is that number each year? And if they tell us that number, and each one of them does, then we can reverse engineer the plan design to get them there in the most cost-effective way possible. So that's what we long to do, and that's what we can do at TRA if you give us an opportunity. Then we handle documents, administration, and compliance matters. The plan investments are selected and managed by you, the advisor. That's the process. Get the information, define the goals, do the design, evaluate the census, and move forward. I want to thank everyone so much for being a part of our call today. We hope that we gave you some information that will help you secure more clients and help your existing clients in meeting their retirement savings objectives, save you some tax dollars, and hopefully being more successful as we exit this pandemic. Craig, back to you. Thank you.
Fantastic, Tom. Thank you. Thank you, everybody, for staying on the full hour. It's been tremendous. John Markley, thank you. John Carl. Hey, I said I'd do a very quick wrap-up at the end. And again, everything presented here, we talked about cash balance, all begins with our regional sales consultants across the country, 15 of them. We'll get that map out to you. We'll get the PDF of this presentation out to you. We'll get the recordings of this presentation out. We're going to get you an ebook on cash balance, everything you need to know about cash balance plans in one tight document. And again, the CE certificate, look for that. Hopefully it won't go into your spam, but it will come in from RLC certificates at simplecert.net. And when you close out, hold on here, because we're going to go through these questions. For those that can stay on, we're going to go through as many questions as we can. But if you have to close out, we get it. Please complete the survey. We want to get better and do better. You're our clients. We value everything you're doing for us, and we're our partnership together. So with that, Bill, can we jump to some questions right now?
Sure thing. Thanks, Craig. First question, is this only for 2020, or will tax year deadline go forward?
Yeah, John Markley, I can answer that. Yes, so for all future years, you will have until the due date for your tax return to implement a retirement plan. It's just that 2020 is the first year.
Thank you, John. Next question, any restrictions or concerns with a company with an ESOP?
That's probably me also. It is, we're probably talking about a larger business. So it certainly is possible to have a cash balance or defined benefit plan along with an ESOP. S Corporation, 100% owned by an ESOP, doesn't have taxes. So the equation for whether this plan makes sense is very different. So probably not a specific answer, but it is possible.
Thank you, John. Next question, is pension money taxed in Michigan?
I apologize, but I have not looked that one up. I don't know for sure.
Yeah, I will say Pennsylvania is the same as Alabama. Retirement income is not taxed. So yeah, I would say you need to check with your local CPA on with respect to Michigan.
Thank you. And I just wanted to reiterate, if we're unable to answer any questions, we will have the respective RSC in your territory contact you and have the discussion offline. Next question. Plan totals are profit share plus cash balance. They do not include the 401k amount. Why? If you want me to repeat that, let me know.
Yeah, I don't know which exhibit you're looking at, but I mean, a 401k deferral is not an employer contribution. So typically, okay, let's go back to one of our designs. Typically, what we do in the design is we include 401k deferrals for the owners because the 401k deferral has the same tax benefits with respect to federal income tax as an employer contribution, but not for employees. So, so that's my answer to your question. And let me look at this specific example. Yes, yeah. Well, I guess because it's a larger practice, it looks like in this design we did not include 401k deferrals, but that's just an extra benefit that the owners could have, that they have the ability to make 401k deferrals.
Thank you. Why is the cash balance contribution amount so low for non-owners?
I can answer that one. It doesn't have to be, but most owners, when they put in a cash balance plan, they say, quote unquote, give me the maximum benefit I can get and make it as efficient as possible, which means keep my cost as low as possible. However, if you have a non-highly compensated employee and you're in the plan that they want to benefit, they certainly can. And they can give them more benefit. That's really easy. If they try to give the highly compensated people more benefit, they can do that too. That's not as easy for testing reasons. But that's the answer. It's all about efficiency. And one other thing I'll add one other thing. Cash balance contributions or benefit accruals create a minimum required contribution. So theoretically, we could give more cash balance to the non-highly compensated staff and less profit sharing. But from the plan sponsor's perspective, I think they would rather have the flexibility on the profit sharing side rather than the commitment on the cash balance side, if at all possible.
Thank you, Tom. Next question. If a business has a simple IRA, does that profit any other plans to be established for last year?
Yeah, unfortunately, a simple IRA precludes the use of any other plan in addition to it. So that's not a good plan for combining with a cash balance plan.
Thank you, John. Next question. How important is it to have the TPA be the same for the 401k and cash balance for testing purposes?
In my opinion, it's absolutely necessary. Because the plans have to be tested together, that way you have one point of contact for both plans, one set of census data, one group doing the testing for both plans, the actuarial evaluation, etc. I think it's absolutely necessary. The coordination would become very difficult otherwise. But John, what do you think?
Well, I completely agree with your point, but TRA is flexible. We have some plans that they have a 401k plan and they really want to stay with their TPA. So we jump in and handle the cash balance plan and then the combined plan compliance testing. But yeah, as soon as I say combined plan compliance testing, that means we're pulling the information from the 401k plan to do the testing. So it is more efficient if we're doing the work on both plans.
Thank you. Next question. where does the pre-funding dollars go? Will they be able to capture the pre-funding back should an employee leave?
Yeah, let me address that. The pre-funding, all of the dollars, let's just say it this way, all of the dollars that are in the cash balance plan account are not, those dollars are not allocated to a participant. Think about it like this. The benefit accrual is, and I hate to say this, but that's what we use, the term, we call it a hypothetical account. So the hypothetical account for our funding example was we credited the owner with $100,000, and then every year he's going to get an interest credit on his balance, and then he's going to have an ending balance, and then we add another 100,000, etc. Those pre-funding dollars are still in the cash balance retirement plan account with the advisor. So they didn't go anywhere. They're not allocated to anyone. No dollars are actually allocated to anyone. The benefit accruals are the benefit that the participant is entitled to, and the bucket of money that's sitting over there with their advisor is what's used to support that benefit if that person terminates and leaves. But the extra funding is not allocated to any participant. In fact, no dollars are actually allocated to any participant, physical dollars. Their account balance reflects what their accrued benefit is. It is supported by the bucket of money.
Thank you. This one, what about a rapidly growing company? So ideal candidate or non-ideal candidate reference.
Yeah, it can depend. Yeah, we have clients who have over 100 employees, and the cash balance plan still makes sense. It really depends on the company's philosophy and goals and objectives. Some employers and their employees like to have significant benefits in retirement. And so that would be an example where it might make sense. But for a rapidly growing company, we should know that when we're doing the plan design so that we can make sure that we advise the client properly.
Thank you. Next question. Can you touch on any funding issues for professional service corps running a combo profit sharing and cash balance plan?
Well, one of the issues is, do you want to go ahead, Tom?
No, that's fine. Go ahead.
Well, for a plan that is not covered by the Pension Benefit Guaranty Corporation, which would be a professional employer with fewer than 25 employees, that means there is a deductible contribution by the employer to the defined contribution plan, a maximum of 6%. If you keep that contribution under 6%, then you can still contribute the maximum to the defined benefit, to the cash balance plan. So the challenge can be if, for example, there is a safe harbor match in the 401k plan, that could eat up a lot of the 6% of pay. And then there's very little contribution left in order to make the non-discrimination requirements of the combined plans work. Tom, do you want to add anything?
Yeah, I'll add some information here. That's why we ask so many questions when we're doing the plan design, because we take that into consideration. And as you saw on the example that for the dentist group, their profit sharing was capped at 6%. So if you cap, and that's 6% of all eligible compensation for all eligible employees. So if you cap that at 6% and you use the 3% non-elective safe harbor, when we do the plan design, we take that into account. So generally that doesn't pop up after the fact. It really doesn't. I've had medical practices that were exempt from PBGC because of their size, but they grew to the point where they were no longer exempt, and then things change. So it's not uncommon. We deal with it all the time. I would not call it an issue. I would call it just a design consideration on the front end. That's what I would characterize that as.
Thank you. And it looks like a Michigan native had provided the tax retirement benefits, which is 4.25 to answer the question earlier. Next question. Could you talk about the types of investments and insurance products that are allowed in a cash balance plan?
Go for it, Professor.
Oh, okay. Yes. So any financial instrument that's allowed in a defined contribution plan is allowed in a cash balance plan. So there are some annuity products out there that might fit nicely into a cash balance plan with the 5% interest crediting rate. I know some plans have life insurance, but life insurance can be a challenge to meet that 5% interest crediting rate. And in general, any other financial instrument is permitted, stocks, bonds, mutual funds, etc.
The only thing I would add, the issue I've ever run into is there was a cash balance plan that we administered that had life insurance in it, and the life insurance was not very liquid, so there typically is another account for liquidity available inside the plan, because sometimes you don't want to pay a surrender penalty to pull money out of a life insurance product. So just be aware that there needs to be some liquidity in there somewhere. So when a participant terminates employment with a vested balance, we need to be able to process that distribution.
Thank you. Next question, two-tier question. If you want me to repeat it, please let me know. What if a business owner is taking a W-2 income as an employee from another company and is participating in their 401k plan as well? Can they have a standalone cash balance plan for their own company?
Well, yes, they can. So let's assume this is an engineer for a moment. So if the engineer works for a company that he does not own, and he gets W-2 compensation, and he participates in their 401k profit sharing plan, that's perfectly okay. If he wants a cash balance plan for his 1099 income for his consulting that he does, that's not for that company, then he can certainly have that. If he has also a defined contribution plan for his 1099 consulting business, then if he maxes out his 401k plan at his regular employer, then he would not also be able to do 401k deferrals in his own plan. But he could have defined contributions like profit sharing, and he could have a cash balance plan of his own.
Thank you. Next question. What number is the sweet spot when it comes to the number of employees in a business for a cash balance plan to be the right fit?
I guess I'll take a stab at that one. Yeah. Well, yeah, why don't I take a stab at it, and then you can add in, Tom. Yes, certainly 10 or fewer makes for the ideal situation where a cash balance plan can add a significant benefit for the owner. But as I've mentioned, we have plans with over 100 participants. And then certainly we've shown in this presentation that plans can have as few as one participant. Tom?
Thank you, John. Yeah, I agree. It becomes really easy when it's a small number of participants, but I can think of one off the top of my head. It's got 86 in it, and there's 12 or 15 owners. One thing I've noticed, if you just have a couple of owners and a lot of employees, that makes it more challenging. But if you have a fair number of owners, like 20 partners in a law firm with another 65, 80 employees, something like that, that still works. It still works. So it's amazing what you might find out if you take a look at them. But I think, yeah, generically, an owner-only plan is perfect and easy and no problem. 10 or fewer is very, very easy. But if you have a large number of non-owner employees and a fair number of owners, I don't know exactly what the ratio is. I may need to look on some statistics for that. But if you have a fair number of owners, it can still work pretty well. It really can.
Thank you. Next question. Is there a vesting schedule for participants? And then next part of the question, no vesting in cash balance account. There is no vesting in cash balance account.
Actually, you can have a 3-year cliff vesting schedule. So in other words, an employee needs 3 years of service to be fully vested, and they are not vested before that. And you can count service, you can count all service with the employer or only service beginning with the effective date of the plan. So there can be vesting in a cash balance plan.
I have an interesting point to add to that, if you don't mind. And this is a bit in the weeds, but it can help. Sometimes you have a business owner that's in their 60s, maybe even 69, maybe even 70. If they could put in a cash balance plan, and even though they're an owner, they don't have to take an RMD until that benefit is vested. So you could put in a cash balance plan, and if they're 68 or 9, and they have till 72, or if Secure Act 2.0 happens, and who knows, they may push it out to 75. So that's an interesting tidbit. You don't take RMD on non-vested money.
Thank you. Next question. Where should we go to educate ourselves further on cash balance plans if we are still unsure on certain aspects of how everything ties together? One spot would be, we do have a handout that's available. If you look on your right-hand side in the toolbar, there's a handouts palette. If you click to download our cash balance ebook, that is an aggregate documentation, as Craig had alluded, that's packaged up to provide as much information as possible in regards to Cash Balance 101, contribution limits, how they work, how to get started, etc. And the next best thing would be to reach out to your regional sales consultant to walk you through it, and then you'd be engaged in conversations with both Tom and or John. Either of you guys want to interject anything else?
Yeah, they could also reach out to RLC Consulting Desk as well, and the numbers are there on the screen. And they're a great partner.
Are there any fund investment types that are excluded, like an annuity?
No.
As John said previously, any investment that is allowed inside a 401k profit sharing plan, another qualified plan, is presumably available in a cash balance plan. But I will also reiterate, you have to have some access to funds if somebody terminates employment and has a vested balance and needs to be paid out. So sure, an annuity can be used, lots of different products can be used, but you do have to have liquidity to pay out employees that terminate maybe before there's easy access to cash inside an insurance product. But you can actually make that work. You may have some money in insurance products and some in a more liquid account.
Thank you. Next question. Do cash balance plans have to pay premium on PBGC?
The answer is yes. If they're covered by PBGC, they do have to pay premium. There's a fixed rate and then a variable rate depending on the size of the plan itself. So yes, if they're not exempt.
Thank you. And this is a follow-up question to one earlier about life insurance. Does life insurance have restrictions to be incidental, as in other qualified plans? Also, since this isn't a 401k, where the participant is confined to certain choices? I'm guessing the employer can select among insurance products to put in a CB plan. Is that correct?
All right, Professor, that one's for you.
If you'd like me to
I'm
repeat
sorry,
that,
Bill,
just
could
let me
you
know.
restate that? Yeah, can you repeat it?
Sure. I'll do one at a time. Does life insurance have restrictions to be incidental, as in other qualified plans?
Yes is the answer to that. Same incidental benefit rules as defined benefit plans. It is more complicated to analyze it because the most beneficial incidental rules are based on a projected benefit. And it adds a lot of administration to a plan to have life insurance, but there are incidental benefit requirements.
Next part of the question, since this isn't a 401k, where the participant is confined to certain choices, I'm guessing the employer can select among insurance products to put in the cash balance plan. Is that right?
Well, I'm not sure where, I mean, it's not a participant by participant selection. So it's a group trust, so the employer would make the decision about investments for the group as a whole.
Thank you. Next question, can you explain how using a life insurance policy and a cash balance plan works with regards to taxes and benefits? Is the policy proceeds to be taxable to the beneficiaries? If you want me to repeat that, let me know.
John Markley, that's for you.
Oh, yeah. There's nothing unique about a cash balance plan. So it's the same as a defined benefit plan.
Thank you. Can you have a combination of funding, say in an annuity and mutual funds?
Yes.
Okay. And then this looks like the last question. Instead of a 5% interest crediting rate, is there an actual return interest crediting rate?
That is an option, but it makes compliance testing very difficult. Yeah, there's actually hundreds of pages of regulations on interest crediting rate. So there is a lot of flexibility. But for smaller plans where you have to project testing based on the actual interest crediting rate for the prior year, and if that rate is variable, it makes the future compliance testing very difficult.
Thank you. That's all the questions that came through our questions panel. Craig, back to you.
Yeah, fantastic. You know, we went an extra 30 minutes with questions and probably could have gone longer. So thank you again. I had mentioned all the handouts and items we'll be getting you in the email. Next couple days, you'll be receiving all this as well as everything you need to know to partner with both TRA and RLC. So thank you. Have a good rest of the day.